Welcome back to Curiosity Class, the podcast where we break down complex topics into easy-to-understand ideas and bite-sized pieces. My name is Jeff Album, and I've been a curious person my entire life. Inspired by Albert Einstein's quote, "If you can't explain something simply, you don't understand it well enough," we aim to make learning accessible and engaging. On this show, we're going to bring you experts from various fields, ranging from personal finance to physics, to help you understand everything from 401ks to how airplanes fly. So let's dive in and satisfy our curiosity together. And welcome back to another episode of Curiosity Class. I'm super honored and privileged to have Rena Myers on the show. Rena, welcome to Curiosity Class.
Hi, Jeff. How are you?
I'm doing great. Thank you so much for being here today. So what I was hoping to do is, I know you as a multifamily investor. And so the goal of this show is to basically explain things as if we're third graders. So I really want to get into multifamily. I want to get into real estate investing. But before that, I kind of want to understand your background and hear a little bit about your story. So how did you get into real estate investing, and what specifically got you interested in multifamily?
I got into multifamily property management and investing about 15 years ago. At the time, I was looking for a change in careers, and I met somebody who owned a multifamily property management company. He was managing at that time like 400 apartments, and I came on to work with him. During my tenure there, when I left, he was at close to 4,000 apartments. During that time, I learned a lot about multifamily investing, property management, what goes on behind the scenes. At that point, I ventured out with another employee there on our own to do our own property management, as well as, so there's two types of property management: owner managed and third party management. We started out as third party, but have since then ventured out into owner managed. The difference being, when you're third party, somebody else owns the building and they're paying you a percentage to manage it. When you do owner managed, you own part of the property and you're managing for yourself. So you have a little more vested interest when you're managing your own, something that you own a piece of.
For sure. And so that first company you were with when you first got into multifamily, that was strictly third, you were only managing for other people? Or did that company actually own their own properties as well?
That company actually did both, but I was just an employee. I wasn't part of the ownership at that time. I was just an employee, and I just, did the back office type things for the company, but I didn't actually have any vested interest.
Got it. And what made you decide that you wanted to go out on your own? Because that's a pretty big leap.
So the person who I went out with, his name is Sam. Somebody approached him to manage a very interesting property. It was the ultimate in mixed use. So usually there are a lot of different apartment type complexes. There's assisted senior living, there's conventional, there's tax credit, there's, student housing, there's Section 8 housing. So normally they're in their own categories. This property actually was very interesting because it was in Towson, Maryland, right near Towson University, and it was a conventional property. So you actually had every type. We had everything from students to seniors to housing and just your regular families living there. So it was really just like every type of property all mixed into one.
Wow. So truly a mixed use area.
Yeah, it was just really a mixed use property, really. The ultimate.
Wow. Okay. So that was the property that got you thinking like, okay, we can do this by ourselves, and this is going to be something to sink our teeth into.
Exactly. And so we did this as third party. And once we did that, we were very successful. After managing it for 3 years, the owners were able to sell it at 10 times the amount that they purchased it for. So they were thrilled.
Holy smokes.
How long were they holding it for? They had owned it, but it had been losing. When they called us on board, it was actually losing money. And we turned it around and we sold it right at the pinnacle of sales for property management, which was like a little into COVID when interest rates were really low and people were super into buying. So we got lucky in some ways, but we did turn the property around. But at that point, we in our contract had a stipend that said that if we sell the property, we get a percentage of the sale. So we
Got it.
decided to take
Got
that
it. Got it.
percentage and buy a property.
Got it.
While we
Okay.
were doing that, though, during that 3 years, we were hired to third property management other properties. So we, at this point, were third propertying about 4 properties, and we went out and purchased our own first property. And then after that, we got investors and we started buying other properties. And now we do a little bit of both.
Okay. Man, that's so cool. And there's a lot of what you said that I kind of want to unpack. But so does that take us up to today? So is that what you're doing today, is a little bit of everything?
Yes, but in December of this year, a new property management company, they weren't new, but property management called Signature Properties approached us to take over their property management, to merge with them, to bring the Greengate properties under the Signature title and to work with them. So they actually owner manage their properties. So now we're in the process of merging those two companies. So the Signature properties are owner managed, and then we work for Signature, and then we brought our properties with us.
Got it. And that was Greengate, you said, right?
Correct.
Okay. And did Greengate do both? So some properties Greengate owns and others Greengate is third party managing for other
Correct.
owners? Okay.
Correct.
Okay. Man, that's super exciting. Congratulations.
Thank you.
So taking a little bit of a step back for someone who's maybe doesn't even know what real estate investing is, they've heard that term. Can you just give a brief overview of what the heck is real estate investing? And then we'll dive into what is multifamily, which kind of what you do.
So real estate investment is just like any other investment. The upside of a real estate investment is you have a tangible item. So you have a building. It could be a commercial building, it could be a residential building, but you actually it could be houses. Some people invest and buy quite a few houses and then rent them, or on a small level, it could be an Airbnb. Your
Mm-hmm.
smallest level of investment in real estate would be an Airbnb. You find
Okay.
a small house somewhere, you turn it into an Airbnb, and then you rent it out, and then you're collecting rents to cover your mortgage, to cover your investment of turning it into an Airbnb, and then a profit.
Okay.
Well, you hope to see a profit.
Hopefully, right.
Exactly. So that would be your smallest, and then it could go all the way up until you have a building in Manhattan with 7,000 apartments or something. It could go run the gamut, or a mall. A mall would
Sure.
also be, because it's the
Sure.
property there. But the difference between that and, let's say, investing in a stock is when you own a stock, you don't have a tangible item. Like
Sure.
if the stock company you own goes out of business, you have nothing. If the property you're managing is not doing well, you do have a tangible item that you could then choose to sell and make a profit there.
Sure. Okay. And so what about is when we say multifamily, what does that mean? Is there a certain unit count or unit threshold where that starts to take into place? Or so we have a single family home. I think everyone kind of knows what that is, right? It's your typical house. What about a duplex or a triplex?
Right. So when I was growing up, I lived in New York, and we lived in a 3-family house. So what was
Okay.
a 3-family house? The first floor was one family, the second floor was us, and the third floor was another family, and we rented the second floor. That would be a multifamily. Multifamily just means more than one family is living in the building and paying rent to somebody. So it could be somebody living in that building, or it could be somebody like myself who, I don't live in any of the properties I manage.
Sure. But
Not
the
that they're
idea,
all not beautiful properties, but
of course. So the kind of basic idea being you buy a property, and in this case it has multiple units, so more than one unit. You buy it with the intent of having tenants live in it and pay you rent, and hopefully covering all of your expenses, your mortgage payment, and any other expenses associated. But the kind of cool thing that you bring is that you're actually managing all the properties you own yourself, or your company is. Did I get that right?
correct.
Okay.
Correct.
Cool. Very cool. And so at what point, what size properties are we talking about? Because I have a feeling I don't feeling you're not doing triplexes.
No. So our smallest property is 114 apartments, and
Okay.
our largest property is 392 apartments.
Wow. Okay. So huge, huge apartment complexes.
Exactly. They're all complexes, and they range from, um, 3-story buildings to, we have one property that's 8 stories.
Wow. Okay. Do you mind kind of giving us some details on that first deal that you bought? So when you had that kind of exciting exit and you were able to sell one of the building, or your owner sold one of the buildings and you guys got that management fee, and you were able to buy your first building. What was that deal like? Because I think,
It was so
I'm a real
exciting.
estate investor. I hear 100+ unit apartment complex. I'm like, dang, that's huge. So how do you do one of those for your very first deal?
So our Sam and our niche market is really properties that need a turnaround. So either they've been managed by the same property management company or owned by the same people for years and no one's really done anything to show them any love. That would be where our niche is. You take a property, you turn it around, and you make it into something better. So we were approached by a realtor. We went to a show actually, went to a show in Florida, and we were just approaching everybody because we knew we had this money to invest. We were approached by this realtor out of Michigan, Inkster, Michigan. I don't know if you know Michigan, but it's not the
Mm-mm.
nicest part of Michigan. And he had a building that had been owned and managed by this couple, and they were ready to retire and sell the property and move on.
And where
And
was it
I mean,
located?
it was Inkster, Michigan.
The property was in Michigan.
Inkster, Michigan. Yeah.
Gotcha.
So they were really old fashioned. I mean, we're talking paper leases. People hadn't been renewed since 2004. I mean, we're already in 2020 when this is, and there were leases that had not been renewed since the people moved in. It was really just a mom and pop. She worked in the office. He would come in and check on her, and it was just really they had it's half housing, half conventional. And it was really just like the leases were a mess. The property had not had any upgrades since I think 1970. I mean, they were old.
Got it.
No one had done anything to them. So we saw a lot of potential, and we purchased it, and we started by slowly upgrading the empty units. Also renew everybody who was on an old lease. We renewed them, but you can't. I mean, we had tenants paying $400 a month rent in a market where 750 was your average rents.
Oh,
So,
wow.
but you can't take someone from 400 to 750 overnight. I mean, people
Sure.
can't afford that, and we didn't want to go down to a 0% occupancy. So we left some people on the old leases, knowing that we renewed the people who were closer to market so we could bring them to a decent amount. And as we upgraded units and filled those units, we sort of moved out the people. Well, we gave them the options. They could either go to market or they could move. And so some people chose to stay because they knew they were getting a killer deal and they knew it couldn't last forever. And so some people did stay, and we just slowly brought everyone up to market, started renovating the units. Once the property was a better clientele, we were able to up rents even more. And that's where we are now. We're at the point of, we're still upgrading units as they come along, but most of the vacant units have already been upgraded, and we're just, able to raise rents as people move out.
Got it. And you said, so this was started in 2020, and so now
Yeah,
kind of middle of 2024. Okay. And how many units? How big was that building?
it's
What was that building?
128 apartments.
Got it. Okay. So, man, ton of questions on that. So you've been doing primarily management, and now this is your first deal, but are you based in the Northeast? Is that your?
We are based in Maryland.
Got it. Okay. So you're in Maryland. You go to this conference in Florida. You meet a realtor from Michigan who decides to tell you about this 128 building that you've never bought a building that size before. And you say, yep, great, we'll do it. So how do you go from managing buildings in your local geography to managing a huge building and a pretty expansive renovation, it sounds like, in a different state?
We alternated weekly. Sam would go one week, I would go the other week. So Sam really focuses on the renovation aspect. I really focus on the leases and the tenants and the rents and things like that. So we would take turns going. We
Okay.
hired a on-site manager. We hired an on-site maintenance person, And it took us a few tries, took us like 2 managers till we found someone. Now we have someone who's great, and she really manages the property. She takes care of everything. We're confident. I still go every 3 weeks to Michigan just to check in with her, make sure everything's running, just so, she knows we're still here. We try to bring her in once a year for some sort of, holiday party. And Sam also goes about once a month just to make sure all the renovations are going smoothly. And we try to split up when we go so that we're never there at the same time, and we can each check on each other's, projects to make sure everything's running smoothly.
Sure. You get kind of a fresh set of eyes.
Exactly.
Gotcha. And is the game plan with this building to keep it? Is there a period of time you want to keep it for, or is there a plan to sell it at some point or refinance? What's kind of the goal?
So we refied in year 3.
Okay.
Going into year 4, we refied.
So recently.
Right. So we did have investors. We didn't buy it 100% just from that money that we got. We did have investors. All of our investors have already received 130% back on their investment.
That's amazing.
So they got back what they gave, and 30%. And right now our plan is just to, right now with interest rates, I don't think we're going to touch our mortgage, but maybe once interest rates start going down, we probably would refi again.
Okay. And is it the building cash flowing positively?
Yeah,
right now?
Cash flowing positive.
Okay. So I just kind of want to do a high level overview of what we just talked about, because I think it's amazing, and I want people to understand it really well. So you bought this 128 unit apartment complex that was performing poorly, right? So it had low occupancy. I'm assuming the rents were well below market.
Honestly, I don't think it was performing poorly from their standpoint. They had owned this building for 40 years. They were they didn't owe any money to the bank, so any money they got was positive for them.
Got it.
So it wasn't cash flow negative when we took it over. They just their thought was, why do any work? Whatever we get each month is money in our pockets. They didn't have a mortgage. They just had to pay taxes and, your regular electric bill, water bill. But other than that, they didn't really have any expenses.
Sure. Okay. Fair enough. So this building you saw potential in this building. It wasn't necessarily performing poorly, but you saw potential and you decided to buy it. And I want to talk about raising money in a second, but you and a group of investors raised money and you purchased this building. You, over a period of 3 years to 4 years, continuously renovated. So improved the units, upgraded interiors. I'm assuming maybe painted the exterior.
Exteriors, interiors, as well as redid the office and made a gym. We added a gym and we added it's not really a conference room, but it's like a space that tenants can come to and chill out if they want.
Okay.
Nice. A TV
like a lounge.
A lounge, right. There are no computers in there or anything. It's just like a lounge if they want.
Okay, cool. And so you made all these improvements. You improved the tenants' quality of life, raised rents and brought them closer to market rents. And then in year 3, did a refinance to pull out, it sounds like all and then more so of the money that you had put in to pay back your investors their initial investment plus 30%. So if we had invested $100, we would have gotten a check for $130. So all of our original money plus 30 extra dollars. And now you're at a point where on a monthly basis, the property is performing very well. It's cash flow positive. So on a monthly basis, it's bringing in more money than it costs. And all of the investors have been paid back.
Correct.
Got it. Okay. That's
so
fantastic.
The investors still get distributions. When you invest in something, just like when you buy a stock, just because I paid you back doesn't mean I don't have to pay you anymore. Right. They still get quarterly distributions.
Right. Okay. Man, that's super cool. And how did you know these investors? How did that relationship get started? Two were friends, friends who said, if you have a good investment, we want to be involved. And then 2 were people who had actually approached Sam and said, we're impressed with what we were doing, and said, if you ever have an investment, please come to us because we have money we want to invest. Got it. Okay. And so I think, it's another good point that I would love if you could kind of touch on is, raising money to buy an investment, it seems kind of counterintuitive. So can you talk a little bit about why people raise money, what that process is like, et cetera?
Well, you have to keep in mind that you're talking about a building that's worth $7 million. And if you're going to take a mortgage, you're going to have to come up with a percent of that 7 million. They're not giving it to you at 100%.
Right.
When you buy a $7 million investment, the bank's not handing you $7 million and saying good luck. As well as, because we were planning on doing renovations, we needed money to invest for those renovations. So we needed more than the $7 million. We needed close to $8 million.
Sure.
We had to redo the parking lot. We had to redo a lot of the landscaping and redo the office. Like, all of these things cost money, and it adds up really fast. And then, there's always those unexpected things while you're doing renovations, an apartment floods, or there's a fire in an apartment. There's always unexpected. So,
are you saying that construction can be over budget sometimes? No.
Shocking news.
Next, you're going to say it can take longer than expected.
Even more shocking. I hate to be the one to share this with you, but true story. So you need this money, and we didn't have that kind of money. The amount we got was nice, but it wasn't nearly that. Okay. So we went to other people, and we had to come up with, I think we had to come up with 1.3 million, because we had to come up with 10% for the mortgage, and then whatever we felt like we needed for the investment, to invest in the property. So, and
just really quick, just one point. So the 10% for the mortgage, that's your down payment, right? So
as your down payment, exactly. Just like when you buy a house.
Sure.
I mean, I know that sometimes they have these zero down, but normally when you buy a house, you have to put down 10, 20, some sort of percentage.
Right. So just to kind of keep the numbers easy, if you were buying a house that was $100,000, you needed 10% down, you need to bring a check for 10 grand, and you get a loan for 90, right? So
exactly.
In this case,
so
the numbers are bigger,
grand,
Right.
Right. But coming up with 10 grand is not so hard normally, but coming up with
700,000,
harder. Okay, but we needed more, because we needed 1.2 million, because we also needed money for the renovations that we were going to do.
Sure.
So the first thing you do is you make what's called a pro forma to show the investors what they can expect. So you take the old expenses of the building plus what you think will be the new expenses of the building based off the old, plus how much more you can increase rents. So we were at that time increasing rents between $100 and $300.
Okay, per unit.
Now the rents at this property are now closer to the 1,040, 1,060. But at that time we were going from, I think they had the rents at 600 for a 1-bedroom and 700 for a 2-bedroom. And we were taking them from 600, 700 to 850 and 900. So
got it.
You then present that to investors and say, this is what we plan on doing. This is what we plan on investing. And if you invest, this is where we see that how your money can grow. And those investors look at your pro forma and decide, yeah, this is a good investment, or no, it's not. And, I don't want to invest. Not every person we showed it to said yes.
Sure. And did you have experience doing these large turnarounds? And did you have a sense of how much construction would cost, how much labor would cost, et cetera, in that market from your past experiences in Maryland?
So yes, we had an idea, because Maryland and Michigan are pretty similar in their socioeconomic. So the cost of things were pretty similar. Also, what we did, because we knew people in the construction business in Maryland, we actually brought our own team from Maryland. They stayed in vacant apartments. We did rent-to-center beds. Wow. And we brought them. This way we knew the quality of work. We knew, if they told us it's going to take this amount of time, it would take that amount of time, because we've been dealing with them for years. And they came and they renovated the units.
Wow. That's so cool. You have a general contracting business as well as a property management and investment company.
No, it's a third-party general contractor, but it's somebody we've dealt with for a long time, and we just brought him and said, listen, we could give you this amount of work if you can source us 10 guys who are willing to go, and they were willing to all pile into a truck. We didn't have to pay for their airline tickets.
Wow.
And they drove down there, and
wow, that's so cool.
Right.
And so now once you're going through and you're finishing these renovations, let's talk about what a refinance is and why it's so cool in multifamily. So do you want to explain a little bit about what a refinance means in this case?
So what a refinance is you go back to the bank with your new, better product, and you say to the bank, over the past 3 years, I've been able to increase rents. I've been able to increase profitability. I've been able to make the property more profitable and have more, be a better asset than it was when I bought it. And now if I was to take this property and sell it, I could now sell the $7 million business for $10 million. And then you say to the bank, would you be interested in refinancing, which means paying off our own old mortgage, giving us a new mortgage? You don't have a down payment on a refinance, giving us a new mortgage for this bigger amount. And the difference between the old mortgage and the new mortgage, you give us to do with what we see fit. Mm-hmm. And then we use that money to give back to our investors.
Sure. Okay. And so in this, I'm probably going to fudge the numbers a little bit, but correct me if I'm super off. So it sounds like the property cost $7 million and needed about $500,000 in renovations. So all in $7.5 million. You were able to increase the property's value to, let's call it $10 million. So now, if everyone remembers that 10% down payment we were talking about before, now when you go to the bank, you say, hey, we want to take out basically 90% of this new value, which is of the new value is $10 million. You can get 90. So you get basically a check for $9 million. You have to pay off the first loan of whatever it was, almost 6.3, whatever. But so you have a fairly large check now that you can go A, pay out your original investors, and B, have some left over to go do with what you want.
Well, not what you want, to reinvest in the property. We decided at that point to do a water conservation. We took a big chunk of the money and we did a water conservation at the property, which meant replacing all of the toilets at the property. So that, because the water bill was very high, and this way would help our water bill go down, as well as it's a selling point when you say to a new tenant, look at your beautiful brand new bathroom. So it was like, it's a win-win. Exactly. It was a win-win. So we took some of the money, invested it there. We repaved the parking lot, things like that.
Okay.
We reinvested it into the property.
Got it. Man, that's so cool. That's so cool. And so now, since then, what are some of the other projects that you guys have done?
So we've also purchased 2 properties in Baton Rouge, Louisiana.
Okay.
So again, now I'm on a flight every other week going. I've narrowed Michigan down to once a month, and now every 3 weeks I'm going to Baton Rouge, Louisiana.
Okay.
We have 2 properties there, and it's very interesting because somebody once said to me that the United States is like a bunch of little countries, but you're all under the same federal government because every state has its own rules and laws and regulations, and even its own language. Like when I am talking to people in Louisiana, I am a northerner, and they see it right away, and they speak differently. They have different expressions that I would never have heard of before, and it's just so interesting. So again, the interesting thing is Michigan is very similar to Maryland in its laws, especially with regards to multifamily, rental, evictions. But Louisiana is a whole new everything we had to learn. We had to learn new rental codes. We had to learn new eviction laws. It was really very interesting. So we did that, and we have 2 properties now in Louisiana as well.
And how did you find those?
So at this point, people there are different websites. There's different companies that will send you properties. When they know you're in the market, they'll send it. So we always get them. And if something looks, this is an interesting thing. If something looks interesting, we underwrite it. So I underwrite property. So I take, what it means to underwrite a property is you take the previous owner's numbers and look at them and see where can you do better. Can you make rents higher? Can you make expenses lower? You look at everything, all of their expenses, all of their, the way they market. Can you market better? Where's their occupancy? Can you get occupancy up? Can you get rents higher? Can you, pay a property manager less? All of those expenses. And if you see that just like the pro forma that you present to your investors, so this is how you create the pro forma, and you see if you feel that the property could make money, then you go to the next step of then saying, okay, I think that this is a property that can make money. I need to find investors.
Got
And
it.
then already at this point, we have a reputation because we're doing third party management still. We still kept our third party management clients, and we're doing and we had given such a good return on this property, and we had sold that other building at such a good return. So people were coming to us and saying, if you have a good property, we would look at your pro forma. And
Got
so
it.
we sent that when we thought it was a good investment, we sent it to these people, and some of them invested in these properties in Louisiana.
Got it. Got it. Got it. And so again, was it a similar model where you had your own trusted contractors go out to Louisiana and have them work on the properties? And like you said,
Yeah,
you're flying down, once every 3 weeks to kind of get on-site management, or at least eyes on site.
exactly. Yeah, we did. We did it again. Again,
Okay.
there's always a vacant or two, one or two vacant apartments. So we actually just had our guys sleep in the vacant apartments, and it just makes it easier when you know the people who are doing the work and you trust them because
For sure.
you know what you're going to get, the quality you're going to get. Whenever you try to bring in a new contractor, you're taking a chance. You don't know what
For
kind of
sure.
quality of work you're getting, and you don't know what kind of length of time, or if they're going to rip you off, or they could start the project and not finish it. This way we always know these are our contractors, these people we've dealt with before, people we trust, and
Well, and it's such a
we're happy
win-win
with their
because
work.
they obviously like working with you too, right? So you're giving
Yeah,
them a set amount of work that they can really sink their teeth into and have, a project ongoing for a good amount of time probably. So they don't have to go
yeah,
out and find new work.
correct. And
Got it.
and they flip out different people, because it's hard to live like that for so long. So the general contractor might send 10 guys, and then 2 weeks later flip it out, bring those guys back, send out a different 10 guys.
Got it. Got it. Got it. Okay. And so are there, it sounds like you're not necessarily picking the markets that you're interested in. You're really looking at property specific. So as people are sending you properties, it doesn't matter so much where they're located. You're really just interested in the numbers. Is that fair?
Numbers, and again, we really like to take a, a, a failing asset and turn it around. In property management, in apartment complexes, there are different levels. So there's an A apartment, an A plus, an A B, a B minus, a C, all the way down. I think it goes down to an F, but yeah. So we like to
We
stay
don't need
in
to
the.
bring up my GPA, and that's not helpful.
So we like. So we like to stay in the C area, purchase in C, and bring them up to a B minus, to a B.
So can you explain what that rating system means? So A to F, what does that mean?
So an A or an A plus apartment would be a beautiful doorman apartment in anywhere in the United States. It could be anywhere. Your apartments would have tons of amenities. You would have a swimming pool, a tennis court. You will have granite countertops, open floor plans, hardwood floors. Just your
Super nice.
super nice, what you would envision a beautiful apartment. Like if you could
Okay.
picture a beautiful apartment, and an F apartment, I have to say I'm happy I've never been in an F, but an F apartment would be what you would envision a slumlord apartment.
Got it.
Really falling apart, holes in the walls, roaches, mice, rats, maybe. Like
Got it.
really just the lowest. But in between, you have a big amount of space in between, a big amount of space between hardwood floors and rotting linoleum. So
Sure.
we try to stay towards the C properties and bring them up to a B minus B property. So C
Got it.
property would be, white collar normally is no, I'm sorry, blue collar employees. Most of our tenants are, again, now we have a bunch of different, but in the beginning, now our properties range. But your average C property would be a blue collar property, people who, want a nice place to live, but can't afford the top. So usually, we'll try to put in wood laminate.
Got it.
And, you're not going to have granite countertops. You're going to have, a regular countertop, but it's going to look nice. It's going to be clean. Your appliances are going to not necessarily be brand new, but they'll be clean and working. I mean,
Gotcha.
I also have that's when that's our ideal, to take it from a C to a B. But now that we've done this merger, a lot of the properties are a higher end. They have a lot of properties that have, and the properties we manage as well. We have some nicer properties that do have granite countertops and do have, black appliances or stainless steel appliances, or, another amenity would be like a washer or dryer in your apartment.
Okay.
Things like these things, so, as we have more types of apartments that we manage and own or operate, we have different classes. But
Gotcha.
our niche to begin with was really taking a lower class apartment complex and just making it nicer.
And
putting in nicer fixtures. It's funny, the little things that you could do that could go a long way. A prettier faucet, a nicer doorknob.
And do you have, when you're doing these renovations, do you try to, so like, let's say you want to replace all the doorknobs, right, in a 100+ unit apartment complex. Are you buying 100 doorknobs at a time?
It really depends. It depends on the renovation, and it depends on the location. Because I have to be honest, if you buy 100 doorknobs and you put them into storage, 50 doorknobs are going to be there when you get back 3 days later. Things walk. So we tend not to overbuy like that, but we would probably say, okay, we're doing the next 5 apartments. We buy enough for 5 apartments.
Got it. And in other words, do you standardize that, or do you try to standardize across?
Standard.
Okay.
Yes.
So you get the same doorknob for the entire building. You don't buy them all at once, but
we try.
Okay.
We try, because again, if I'm starting, so my first apartment I'm renovating in the beginning of 2024, by the time I get to the last apartment I'm renovating, it might be 2020, end of 2025, that product might no longer be available. And if that's the case, I might have to change it up and get it different, but similar. We really try to do as close as possible, because people, the best way to get a new tenant is resident referral. People telling their friend, I love where I live, you want to live here. But if I bring you to an apartment where your friend lives and show you an apartment with beautiful black knobs and, granite countertop and, black appliances, and then I rent you an apartment that's white appliances with linoleum flooring, you're not going to be interested. So we try to keep them like similar across the board.
Got it. And I was wondering this. You're saying that your niche is to buy C properties and bring them up to B class, right? Why not bring them up to A?
If you're a C property, you're not in an A area.
Got it.
It's very unlikely that there will be in a C property in an A neighborhood. And there will be an A. And if I'm going to pay the rent for an A property, I don't want to live in an area that I'm surrounded by C properties.
Got it.
Neighborhoods are neighborhoods. You don't find them. You do on occasion, but you'll rarely find a mansion in a mix of a bunch of row homes.
Sure. Okay.
So same with apartment complexes.
Got it. No, that makes a lot of sense. Well, man, that's super exciting all around. It sounds like you got your work cut out for you, and you're doing a whole lot. So when you think about the future, what do you want to be doing in 3 years? Is this kind of continue with this method, like continue looking at properties, continue underwriting deals, continue purchasing properties and turning them around?
Yeah. Personally, my ideal for me personally is I'd love to go out and do something in this field, but a little different. I would love to do asset management for like a family office, where they're investing and I would be the one making sure that they're getting the most for their investments. So it's a little bit different than what I'm doing now, but it's basically in the same realm. So where somebody, I would get the underwriting, I would look at it and I would decide, this is a good investment for this family office.
Got it. And what's the difference between asset management and property management?
So asset management, property management is where you're managing the properties. Asset management is where you're looking at the overall picture of all the assets in the group, as opposed to property management, where I'm managing an actual building. If you owned 7 properties If you invested in 7 properties and you wanted somebody to make sure that your assets were doing well, I would want you to hire me to go out and make sure that the property management people are managing it well on their end. So that's where
Got
I
it.
would love to see myself in 3 years, really managing, properties like
Well, it
that.
sounds like you're well on your way.
I hope so.
Man, what
Maybe
was I
one of
gonna
your
say?
viewers is looking for that. Who knows?
100%. That's what podcasts are great for, right?
Exactly. You never know.
If you were to try to get started into real estate investing now, knowing what you know now, is there anything you would have done differently, or would you have done everything the same?
In 2024, right now,
Right now?
um, I would tell every single person who I manage for, do not get an adjustable rate loan in 2021. Everybody thought adjustable rate loans in 2021 were the dream. They were amazing because here you were getting these like 3% interest rates and they were dropping.
Right.
But guess what happened in 2023 to 23? That 3% loan, which dropped to 2% and you were in heaven, went up to 8 and 12%. And all of
Right.
a sudden your interest payment went from 40,000 to $80,000.
Right.
So it's a real right now, this industry, that's the biggest problem in this industry right now. The amount of people who had adjustable rate loans, as well as the interest rates being so high. It's very hard right now with interest rates where they are to find a good investment
Mm,
because part of your things that you have to look at is how much am I going to be paying each month to the mortgage company? And when
right.
your interest rate is at 10, 9, 10%, it's not as pretty as it was when it was at 3 and 4%.
Right. This is something that always frustrates me when I'm, since 2022 and you're looking at real estate prices is, okay, like you were saying, in 2021, you could get a loan for 4% interest, right? So that means, let's say you get a $100,000 loan, you owe $4,000 in interest every year, but you divide that, you pay monthly, right? Now the interest rates have gone up to 8, 9%, like you're saying, but so your monthly payment has effectively doubled, but the home prices have not gone down as much as they need to make your monthly payment the same as it was before. So it's always been very frustrating to me.
So what happened during COVID is everybody was selling their house at maximum amount because I don't know
Mm-hmm.
why, because mortgage rates were so low, people were excited to buy.
Well, also they probably wanted more space. They wanted to move out to the suburbs, and
Exactly. And the price of housing in general, not apartment housing, of home buying went up tremendously. We in the apartment complex industry were not allowed to raise our rents during COVID. We had a
right.
moratorium on rents. Like that. So people who are the price of houses went up astronomically during COVID. And the problem is they haven't dropped. They're
Right.
still where they were then. And I don't know if people are thinking, if I could get it then, I could get it now. But and they can, because the problem is if everyone's charging that, supply and demand, I have to pay what they're asking.
Right.
So,
Right.
if everybody raised the price of houses by 100,000 and no one's willing to drop it,
And people are
so
buying them. People are
and
paying
people
for
are
them.
buying them, right?
Yeah. Yeah. I mean, if obviously no one has a crystal ball, but what do you see as the future of real estate in the next 12 months to 24 months?
We're having an election in November. I
Mm-hmm.
think that depending who wins the elections, that will be the real deciding factor because I think, that could drop, interest rates can drop. They right now we're in a recession. So it really the economy. It really I think that nothing is going to be clear until we know who our next president is.
Hmm. Interesting.
Because,
Interesting.
really
Interesting.
depends.
So but are you still buying apartment complexes from now until then, or trying to?
We are trying to. We're always trying to, but as I said before, because interest rates are so high, it's almost impossible to find a good deal. So,
Hmm.
what people are expecting to happen, because so many people, and I don't know if this will or it won't, but this is what people in the industry think might happen, is a lot of people bought these properties on an adjustable rate mortgage. And as you said, their mortgage went from 40,000 to 80,000. And now they are operating in the red and they can't afford their mortgage payment. So it could be that there will be more on the market at better prices in a few months. But again, only time will tell. You know,
Right.
banks don't love foreclosing on apartment complexes.
Right. Right. Man, well, excited to follow you and continue seeing what you guys are doing, because it's very impressive what you've built, and it sounds like what you're continuing to build. So congratulations, and yeah, all that you've been doing. Besides any family
Thank
office
you.
listeners that want an asset manager, is there anything else that you're looking for that people can help you out with? If you need anything, how can people help you?
Well, if anybody is also looking for a third-party property management, we are happy to take on more properties.
Cool.
You know,
Do you have
we
a threshold?
tripled in January. We went from 1,200 to 3,200, and we'd love to go from May to June from 3,200 to 6,400.
Wow, that's
Yeah,
amazing.
we'd love to take on more properties.
And do you have a minimum unit size? Like, it has to be at least a certain amount of units?
To buy, yes. To manage, probably both. To buy and manage, we wouldn't do anything under 180.
Under 180. Okay. Okay. Well, hopefully I'll be calling you very soon. Not there yet, but
I look forward to it.
we'll
I'll be
get
waiting
there.
for your call.
And how can people find out more about you, about your companies? Where can people
Well,
find
we're
you?
on LinkedIn.
Okay.
They could connect with me on LinkedIn. I love connections on LinkedIn. That would really be the best way to look into us. You know, we're all Signatures on LinkedIn, Greengate's on LinkedIn, and Rena Myers are on LinkedIn. And if people want to reach out to me or if they have questions, I'm really happy to help. You know, if people are looking at a property and they want a fresh set of eyes, I'm happy to help with that. You know, look at it and tell them my opinion. I'm a very conservative investor, especially in this market.
Got it. And we'll link to your LinkedIn profile in the show notes and all that good stuff.
Amazing. Thank you.
Thank you so much for coming on, Rena. I really appreciate you and your time, and thank you for explaining multifamily to us.
This was really fun, so thank you.
Thank you.